All right, let's go ahead and get started. Today is Wednesday, October 2nd, meeting being recorded. I'm going to pass around the sign-in sheet. Make sure you sign the sign-in sheet before you leave today. Any questions about Monday's presentation or US or the conversion assignment? If you've seen your grades, if you do have questions, please work them out with the TAs. But what we're going to primarily spend our time on today is the next step. After we've converted the statements, we are going to start analyzing the statements. So today, we're going to talk about ROIC trees and CFI. Okay? And that will be your next homework assignment due on Monday and will eventually become your next team projects. Also, before I forget, Friday, make sure you turn in, I think it's Friday, October, check the assignment date. Peer reviews are due. So I mentioned this before, but for your last group project, you will submit, here on the screen, you will submit a peer review by October 3rd, actually it's tomorrow. Okay, so again, open a spreadsheet, put all the members of your team into different rows, and then put 0 to 100% by each of their names, including your own. If you felt they fairly contributed, 100%. If you felt they didn't adequately contribute, less than 100%. If they didn't show up, 0%. As I said, if 2 or more members of your team rate you less than 100%, I will lower your grade based on a weighted average with your overall group score. Otherwise, everybody gets the group grade. Okay. If you don't submit a peer review, you lose a point towards your semester grade, and you can no longer opt out of the final exam. So everyone needs to submit a peer review. Okay, questions about that? All right, so back to our lecture note from last week. Let's go back to the ROIC tree. So we're about to look at 5 historical years of return on invested capital and why it's changing. And there'll be 2 levels of analysis we'll do. One, the first level, tax rate, margin, productivity, and then the second level, drivers of the income statement and the balance sheet. Okay. And what I'm about to show you is very real world, right? Meaning, working with a company next week, we're going to take their data, it's going to be in this format, we analyze it. Okay. And so it's something McKinsey uses, something we're going to use, something very instructive about companies even beyond this class. Right. So let's talk about a tree. But before we talk about the tree, I want to put on a new slide, which I use as a whiteboard, to highlight an important point about what we're going to do. Okay. When companies measure their own performance, and even sometimes when investors look at them, they look at margin. How much do you make when you sell something? Which I will express as profit divided by sales or revenue. And that's called margin. How much do I make in profit when I sell something? Okay. But investors don't care about sales. If you think about it, investors care about ROI. So yes, how much profit do I make divided by how much money did I give you, investment or invested capital, P over I, right? So investors measure P over I, ROI, and companies measure margin, profit divided by sales. Not quite the same thing. Right? So the question is, how do we connect the 2 together? How do you connect margin with return on investment? Well, here's where algebra comes in. If you take P over S and multiply by blank over blank, you'll get equals P over I. What is the blank over blank? What does it have to be? P over S times what is P over I? Guys remember your 8th grade algebra? Close, S over I. Okay, it'd be S over I, and the S's would cancel out. Sorry, I don't do a good job drawing my trackpad. And you get P over I. But the important reason to write out the simple algebraic equation is that multiplication sign tells us these two things have equal weight. So there are two things that have equal weight in explaining return on investment. One is how much you make when you sell something. Two is this new ratio S over I. How much did I invest in order to sell the dollar? That is something we'll call productivity or efficiency. Okay. And those are the two drivers of return on investment, mathematically have to be. And that's what's key about the tree, right? Now, on the tree, you're going to see a reciprocal. So instead of S over I, you are going to see I over S. So that P over S times 1 over I over S equals P over I. But the reason I'm going to do reciprocal is everybody kind of thinks in terms of sales, and it actually makes the tree additive across. So it makes it easier to do the tree. Okay. So let's start out with a company, Costco. Here is Costco's 5-year ROIC tree. Okay. So for your next assignment, you're going to get an ROIC tree of a company. Okay. And it's going to have 5 years of data on it. And your goal in your 500-word minimum paper is to analyze using numbers the entire tree and why the ROIC changed over 5 years. Okay. So starting with the left side of the tree, end of year ROIC. In 2019, Costco's ROIC was 22.4%. In 2023, it was 26.5%. That is an 18.4% 5-year improvement. Okay, so ROIC got better over 5 years. Why? 3 drivers, 3 reasons, always 3 reasons, any company. Reason number 1, tax rate. In 2019, Costco paid 22% in taxes, 22.3% taxes. In 2023, they paid 25.9% in taxes. Is that better or worse, more favorable or unfavorable to ROIC? If you're paying more in taxes, does that improve your ROIC or worsen it? Better or worse to ROIC? If you pay more taxes, does it help or hurt your ROIC? Makes it worse. Exactly. So one of the reasons that Costco's ROIC should have gone down is they're paying more in taxes. Now their ROIC actually went up, but that was still a headwind. Now, if we take out the impact of taxes, we have the pre-tax ROIC, the actual underlying business, selling stuff out of their warehouses, right? In 2019, Costco's pre-tax ROIC was 28.8%. In 2023, it improved to 35.7%. That's a 24% increase. Their pre-tax ROIC got better. Why? Drivers 2 and 3. Driver 2, operating margin. How much profit does Costco make on every dollar of sales, pre-tax? In 2019, that was 3%, 3.1 cents. In 2023, 3.3 cents. Slightly more favorable. So they're making a little bit more profit on every sale. That is going to help the pre-tax ROIC. And by the way, all of this you are writing and putting into your 500-word paper. So taxes hurt them. Margin helped them. Driver number 3, productivity. To sell a dollar of sales in 2019, Costco invested 10.8 cents. So they had 10.8 cents of invested capital to drive a dollar of sales. To sell the same dollar in 2023, they spent 9 cents, 9.4 cents. Is that more favorable or less favorable to ROIC? If you spend 1 penny less to sell the same amount of product, does that help or hurt your ROIC? That helps. So productivity favorable, going from 10.8 to 9.4, they saved a penny there. Profitability is a little favorable. They went from a 3%, 3.1% margin to a 3.3% margin. Both of those drove their pre-tax ROIC from 28.8 to 35.7. Now, because these two things multiplicative, operating margin times invested capital over sales equals pre-tax ROIC, it really was the 13% drop in invested capital that probably had more impact on the pre-tax ROIC going up, but they both were favorable. That is your first level analysis. Questions? Second level analysis. What explains the change in the operating margin? Well, that's coming from the income statement. So over on the right are the three drivers of the income statement. Gross margin minus SG&A minus depreciation equals operating margin. So those three things explain the operating margin change. Let's talk about each of the three. In 2019, Costco's gross margin was 14%. 2023, their gross margin was 13.1%. Is that lowering of gross margin favorable or unfavorable to operating margin? That help or hurt the operating margin? It helps. Higher gross margin, price minus cost, means more operating margin. So one of the reasons their operating margin went down, it hurt them, is because their gross margin went from 14 to 13. That hurt them. SG&A, spending on overhead, selling general administration as a percentage of sales. In 2019, Costco spent 9.9 cents per dollar in SG&A. In 2023, they spent 8.9 cents per dollar of SG&A. Basically 1 penny less in SG&A to sell the same product. That helps their operating margin. And they kind of cancel each other out. Like the lower gross margin is being offset by the reduction in SG&A. The third driver is spending on depreciation. In 2019, Costco spent 1 cent per dollar on depreciation. In 2023, they spent 0.009 cents per dollar. That's a 0.001% improvement, lower depreciation, more margin. So SG&A and depreciation help their margin. Gross margin hurt their operating margin. But net, it was the reduction of SG&A and depreciation, which overall, particularly the SG&A, which helped drive the slight improvement in operating margin. All this is going in your paper using numbers. Second level drivers for productivity. Why did invested capital to sales go from 10.8 to 9.4? Three parts of invested capital. You just did this in your conversion and your last assignment when you did operating ROIC. WC is operating working capital. So working capital plus PP&E to sales plus goodwill and intangibles equals invested capital. So these three things sum to this. Okay. So what's driving invested capital more favorably? Working capital went from -2.9 to -2.7. So let's talk about where working capital comes from and what makes it positive or negative. Okay. So I'm going to use some made up numbers that are hopefully directionally correct. So let's say you're Costco. Where is PowerPoint? All right. So you got some inventory in your warehouse. And let's say that inventory sits around for about 30 days. So you're financing your inventory for 30 days. Okay. And then somebody comes in and buys something. Well, at Costco, all the transactions are coming in by credit card. So they're going to have some accounts receivable from Visa, but basically, it's supposed to be an A, accounts receive. Sorry, I have trouble drawing an R with my mouse. It's supposed to be an R. Back to the A, accounts receivable. But the point is, they're going to get paid by Visa in about 2 days. So if you think about it, Costco is tying up cash in working capital for about 32 days. Loose numbers, okay? 30 days of inventory, 2 days to get paid by customers. Well, what Costco is going to do is they're going to pay their suppliers accounts payable, AP, in 45 days. So basically, they're going to get money from you before they pay their suppliers. Same thing. This morning, I walked into Safeway to buy a box of cereal, right? The whole idea of a grocery store with low margin business, they're going to pay Kellogg's or General Mills or whoever for that box of cereal in 30 days, or sorry, they're going to have 30 days of inventory, not much on the shelves. They're going to get paid cash or credit card, and they're going to pay their supplier after 45 days, 60 days after they sell their inventory. So the whole idea is the suppliers are funding the inventory. That's negative working capital. Okay. And that's the whole point. I have negative working capital because my AP is greater than my AR in my inventory. Now, that's not true for an oil and gas company, right? That's not true for a pharmaceutical company, right? They're going to have bunches of inventory, and a pharmaceutical company might take 90 days to get paid by an insurance company. So, long story short, they would have a lot more inventory receivables than payables. They're going to have positive working capital. Okay. So just give you a sense of where negative working capital comes from. So Costco, retail company, has negative working capital. They had negative 2.9 cents of working capital in 2019. And they had negative 2.7 cents in 2023. Even though it was negative, it was less negative, which means they added to their invested capital. And that was more favorable, or more unfavorable, I should say, to ROIC, because they're tying up more cash in working capital, even though it's negative. It's because it's less negative. PP&E to sales went from 13.7 to 12.1. That's favorable. They're spending less on the stores relative to the revenue that's coming out of them. So they got more productive by about 1.6 cents per dollar in PP&E. So if you really want to look at it, 1.6 cents per dollar of lower PP&E, and they don't really do acquisitions, no intangibles, drove invested capital sales down from 10.8 to 9.4 is the primary reason, along with a reduction in SG&A spending, which improved their operating margin from 3.1 to 3.3, which led to a pre-tax ROIC increase from 28.8 to 35.7. Despite the headwind of the slight higher taxes of 22.3 to 25.9, led to an overall ROIC improvement after tax of 22.4 to 26.5 over the last 5 years. That's your paper. That's at least 250 words. You have to cover every item. You must start from left to right. You must explain the changes from the item on the right to the other item on the left, why it went up or down. Okay. Once you've gotten through the whole tree, you summarize right to left, as I just did, going back to the ROIC. Now, if you're really good at this, which you're not, and you're just starting to learn this, you could just go the whole thing right to left. Okay. But I want you to start left to right and then summarize right to left. What is driving the changes of ROIC? Cover every first level driver, explain the change. Cover every second level driver to the first level driver, explain the change. Questions? Yes.
The percentage change average year by year.
The percentage change is the difference between year 1 and year 5. But be careful, right? Because the problem with the percentage change, and I'll show you here, is going from 1 cent to 0.009 cents is a big percentage change. That's not going to be as meaningful as the 10% drop in SG&A, which is a 1 point drop in SG&A. So percentage changes are a guide, right? They're not absolute. So what's more important in the absolute tree is the absolute numbers. But nonetheless, the percentage change kind of gives you a sense of directionality and a little bit of magnitude on that item. But you can't do this tree on purely percentage change. When you do the tree, you must cover every item, you must connect the dots, and you must talk about numbers. You've got to use numbers. Can't be general. Can't just say the ROIC improved because the tax rate got better, like 0 on your assignment, right? Now, for this assignment, the training wheels are on. What I mean by that is year 1, year 5. Just cover year 1, year 5, connect the dots using numbers. Starting with the next assignment, the middle years count too. We're not just going to ignore the middle 3 years. We're going to start talking about the middle 3 years. And real world context, right? So harshly, on Monday, I don't think it was this section, but one of the teams that presented their group project, EIC, and Live Nation, did not mention in their PowerPoint or their presentation the DOJ lawsuit. And at the end, I asked some team questions. I said, what about DOJ? And they're like, what do you mean? What are you talking about? Okay. Now, I will tell you that that did not help their grade. Okay. Because you can't do a EIC on Live Nation and not talk about their monopoly being under threat by regulators. I mean, it's a real key issue in their business. Well, same is going to be true with any company going forward. Like, it's not just the numbers in Costco. What's going on in the real world that's making these numbers better or worse? You will know the answers to that, and you will put that as part of your analysis. In fact, when you do your next group project presentation, if you spend 10 minutes and you don't know anything about the company you're presenting the data on, don't expect a good grade. Right? Now, for this homework assignment on Monday, I'm not asking you to do all that. You got to learn how the tree works. But the point of the tree is to give you real good context of what's happening with a company. Okay? Questions about any of that? Okay, practice. Here is Nike's 5-year ROIC tree. These trees are actually generated by a valuation model that you will be building in the second half of the semester. Okay. Now, since you don't have this model yet, I'm giving you these trees. This is a 5-year ROIC tree of Nike, same format of Costco. Okay. So this tree exists in the files folder, in a subfolder called Nike, and it's called Nike ROIC.pdf. You need to open up and download that file, or download that. Okay. I'm going to give you 10 minutes to practice analyzing Nike's 5-year change in ROIC, and then we're going to go over this. Okay. And this is not being turned in for a grade right now. Very similar to your next homework assignment, Monday. But the point is, you can talk with your peers side by side. Like if you want to do this like a team of 2 or 3 to talk about this, but talk about the 5-year ROIC change in Nike. And then in 10 minutes, we're going to debrief. So for the ROIC tree of Nike, because I'm doing this in a video, I'll save you some pain of asking you lots of questions. But what you should have started with is a 40%, 40.1% ROIC in 2019, falling to a 31.6% ROIC in 2023. All right, so their ROIC went down by 21.2%. Reason number 1, tax rate. Their tax rate was 16.1% in 2019. It increased to 18.2% in 2023, resulting in a little unfavorability to ROIC. So one of the reasons that Nike's ROIC fell is they're now paying more in taxes. Okay, but that's not the only reason. The underlying business is selling shoes and apparel. Pre-tax ROIC went from 47.8% to 38.7% over the 5 years. So that got worse too, right? Now we go to drivers 2 and 3, margin. Why pre-tax go down? How much do they make when they sold something? In 2019, their margin was 12.2%. In 2023, their margin's 11.5%. Nike is making less money every time you buy something from them. Okay, so that's hurting their ROIC. Driver number 3, invested capital to sales. In 2019, Nike spent 25.5 cents of invested capital to drive $1 of sales. Last year, 2023, they're spending 29.8 cents of invested capital to drive $1 of sales. They are spending more to sell the same products. That is hurting their ROIC. All 3 things are unfavorable to Nike. Right? They're making less when they sell a product. They're spending more to sell that product, and they're paying higher taxes. All 3 are driving their ROIC down. That's the first level analysis. Which, by the way, when Nike's CEO got fired last month, this wasn't a short-term thing. This has been a long-term challenge with Nike, right? It's not overnight. You can see that in their numbers, right? Now, second level analysis. Why did the operating margin go from 12.2 to 11.5? We looked at the income statement. 3 reasons. Gross margin. 2019, Nike's gross margin was 46.5%. Fell to 44.9. Price minus cost of the product went down. Right? When a higher gross margin is better. So that drove the operating margin down. So one of the reasons the operating margin fell, lower gross margin. In 2019, Nike spent 32 cents on SG&A, 32.5 cents. In 2023, spent 32. Slight favorability. Didn't change much, but they did spend a little less per dollar in SG&A, not enough to offset the drop in gross margin. And depreciation as a percentage of sales went from 1.8 to 1.4 over the 5 years, 2019 and 2023. That was favorable as well to the operating margin. But unfortunately for Nike, what really hurt their operating margin primarily was the drop in gross margin. Got to cover every variable. Let's go to the second level drivers productivity. Why did invested capital sales go from 25.5 to 29.8? Why did it get worse? Working capital. Nike has working capital. They're not like Costco. Right? Nike spend 12.3 cents per dollar on working capital in 2019. To sell the same products, 13 cents per dollar of working capital per dollar of sales in 2023. That's unfavorable. That hurt their productivity. More invested capital. PP&E to sales went from 12.1 to 15.6. They're spending a lot more on facilities and equipment to drive sales. That's hurting invested capital. Nike in 2019 had 1.1 cents of goodwill. In 2023, 1.1 cents of goodwill. They do some small acquisitions, but the point is the total value didn't really change. It's no big spending on acquisitions. So really, if I summarize, what really hurt Nike's invested capital sales was the increase in PP&E to sales. They opened up a bunch of stores and facilities and didn't get the corresponding sales. And coupled with a drop in gross margin, they're not getting the same margin on their products. Led to the drop in operating margin and the worsening invested capital sales led to a drop in their pre-tax ROIC, which fell from 47.8 to 38.7, coupled with higher taxes from 16 to 18, led to an overall ROIC after tax decrease from 41 to 31.6. You work from left to right, you summarize right to left. You cover every item. Don't skip. Okay? And that's the point. The reason I want you to work from left to right, I want you, the number on the right generally explains the number on the left. Connect those dots. Once you've gone through the whole tree, summarize. What are those things really affected the overall? Okay, summarize. So, as I said, that's your analysis. That's minimum 250 words in your paper. On Monday, minimum were years 1 and 5. Now, you want to start practicing by doing the middle years, go for it. Doesn't hurt. But at least years 1 and 5. Questions? That's the first statement. The second statement you're going to analyze is called the CFI. Okay? We converted that. You did your homework assignment on it. we took financial statements and we converted them to Modigliani Miller and came up with a statement of CFI, cash flow. 4 parts to it. Operating free cash flow, those were the ones, plus non-operating cash flow equals enterprise value, in this case CFI. And that CFI is what can be paid out will equal to the interest-bearing debt, the equity. That was the structure of the statement. Now we want to explain that structure. Okay? So in the context of Costco, back to Costco. This is Costco's 5-year CFI. The 5th column is the total, is just the sum of the 5 years worth of cash flow. Okay, so what happened over the 5 years? That's the total. Now, for your training wheel assignment, homework 6, you're just going to worry about the total. Starting homework 7 and beyond, you're going to worry about the 5 years. What happened each of the years? And then real world context. All right. Every CFI analysis you do, you start with free cash flow. You always start here, because that number is going to tell you how your analysis is going to go. If you have positive free cash flow, that means you generated more cash than you spent. Where'd the money go? So a lot of your analysis is, where did that free cash flow go in those other 3 sections? Non-operating, debt, equity. If you have negative free cash flow, which means you spent more than you made, where did the gap get funded? Did you get the cash from non-operating, debt, or equity? So free cash flow kind of frames how you're going to write your entire analysis. If positive, where'd the money go? If negative, where did it come from? Well, we'll start with free cash flow. Over 5 years, Costco generated $17.766 billion, $17.8 billion of free cash flow. Why? From the income statement, they generated $33.7 billion of gross cash flow, no PAT plus depreciation. They reinvested in working capital and CapEx $15.9 billion of their gross cash flow. That led them to a free cash flow before acquisitions of $17.8 billion. Their reinvestment rate was 47%. If you take the 15.9 and divide by the 33.7, you get 47%. Costco's reinvesting 47% of its gross cash flow back in its business. What's their theoretical payout rate? Yeah. Yeah, 53%. 100 minus that, exactly right. So the point is, Costco, if they're reinvesting 47% of their income back into the business, they theoretically could pay out the rest. So 53 is their theoretical payout. Now, of the 17.8 billion of goodwill before goodwill, free cash flow before goodwill, they don't do acquisitions. So that became their overall free cash flow. Okay. Next, how did 17.8 billion of free cash flow from operating activities turn into $11 billion of CFI to pay out to debt and equity holders? So clearly they took, rounding off, $6.7 billion worth of cash, and they put it into non-operating activities. So let's explain that. What happened to non-operating cash flows? How do you get from 17.8 to 11? Okay. So first, they generated $46 million worth of FX losses and non-operating gains and losses on FX. Trivial. Primarily, they made $819 million worth of interest income. What's helping your CFI? You make profit, adds to the cash you can pay out. They bought $1.6 billion of non-operating assets. I don't know what they bought, but I do know they bought something. And they put almost $6 billion increased excess cash. All right. So again, I'm going to give you a metaphor that helps you keep this straight. Oversimplifying. I have a Chase checking account where I pay all my bills. Car, mortgage, rent, credit card, food, groceries, all coming out of there. Netflix, all coming out of my Chase account, paying my bills. Okay. I have a Fidelity retirement account. It's my savings account. Okay. I don't use Fidelity to pay my bills, 401k, right? It's my long-term savings. So here's the point. If I take money out of my checking and I send it to my 401k, I can't use that to pay my bills. So when excess cash goes up, I move money into savings, it actually reduces my CFI because I have less cash in my account to pay my bills. If I spent more than I made and I need to rob my 401k and I take money from Fidelity and I put it in my checking with a tax penalty, that's not good, but I don't have to. Well, then I basically reduce the excess cash. I reduce my savings and I increase my CFI because I have more money to pay it out. And I want you to think about that metaphor when you think about companies, because the same concept. When Costco sends almost $6 billion of cash to excess cash, they're reducing the cash that could go to the debt and equity. That reduces their CFI. If a company were to lower its excess cash, then what it's doing is basically taking its savings and using it to pay bills. So that helps explain the sign here. So really, where did Costco reduce their CFI? Because they put 5.96 billion of cash into excess cash, and they bought back, or they bought $1.6 billion of non-operating assets, reducing almost 18 billion of free cash flow to 11 billion of CFI. That is the cash that can be paid out to the debt and equity holders. Is everybody tracking? Next, where'd the 11 billion go? Who got the 11 billion? 605 million went to pay interest. They have debt. There's interest on the debt. That was the payment to the debt holders. Costco increased their debt by $2.7 billion. They issued new debt. Now, this is a midterm exam question for several semesters. Last semester, 30% of the people in this room would have missed this question in the midterm exam. I'm telling you, it's going to be on your midterm exam. And I'm going to give you the question right now. Was this $2.6 billion increase in debt necessary? Did they need to borrow this debt, Costco, over the 5 years? There's an absolute right answer, yes or no, and why? Did they need to borrow $2.6 billion worth of debt? And if you answer that, yes or no, why? And the answer is right on the screen. Yes or no? Want to take a shot? Costco need to borrow $2.6 billion worth of debt. Yes. No, that is the correct answer. They did not. Why not? Which one? The CFI. If I have $11 billion worth of CFI, that means I generate $11 billion more cash than I spent. I don't need to borrow $2 billion worth of debt. I still got $11 billion worth of cash. Everybody see that? In fact, I'll go one level up. If I generate $17.8 billion worth of free cash flow, profit after reinvestment, I put all the reinvestment I need in the business, and I still got almost 18 billion left. I don't need to borrow debt. So why did Costco borrow the debt? Hold that thought. Hold that question. Keep going. So they borrowed $2.6 billion worth of debt. Of the 11 billion, they gave 500 million to the minority shareholders, dividend cash distributions. Okay, so that's where some of the cash went. So some went to interest, some went to minority shareholders. Costco paid dividends of $11 billion over those 5 years. Okay, so $11 billion worth of dividends went to the shareholders. Costco bought back $2 billion worth of shares over 5 years. So the thing about cash going to the shareholders, 11 plus 2, Costco gave $13 billion of cash to its shareholders over the last 5 years. How do you give $13 billion of cash to your shareholders if you only have $11 billion to pay out? Anybody answer that? What'll be that? There's the debt. It is really clear that Costco borrowed that debt to buy back the stock. They didn't need to borrow the debt. They could have paid the dividend with the cash they made. So to fund the share repurchase, they issued debt. That's not an indictment. A lot of companies did that, but it's just factual. And you can see that. I told you when you converted these statements, you're going to hate converting them, But once you do, it gives you much more insight into what's happening with a company. And that CFI is really telling about what's going on with the cash flow of a business, right? Now, again, a lot of companies, remember a couple of years ago, interest rates were all-time low. Why not take advantage of all-time low interest rates to basically borrow debt and pay back your shareholders, right? It's like almost free money to your shareholders. A lot of companies did it. I don't blame Costco for doing it, but that's the point. That's what they did. They didn't pay out more because they made more. They paid out more to shareholders because they borrowed it from the banks, right? Well, that's not as recurrent. It's not as long-term. So don't get me wrong, as an investor, I like cash, but where'd the cash come from? The cash came from the banks. The cash didn't come from customers. So that's not something they're going to be able to recur that share repurchase over time. Something in the back of my mind when I think about a company. Is that, everybody follow, track, questions about that? That is a CFI analysis. Now, again, we'll kind of year by year later, but at least start with the total. Practice. In that same folder, files folder, there is a Nike CFI with a total. I want you to spend the next 5 or 10 minutes analyzing and explaining Nike's 5-year change in CFI. Then we're going to go over. All right, so looking at Nike CFI. All right, you start with free cash flow. Nike's operating free cash flow, 18.1 billion over 5 years. All right, they generated 27.2 billion of gross cash flow, and they reinvested 8.9 billion in working capital and capital expenditures. That represented a 33% reinvestment rate, a little lower than Costco, and theoretically a 67% payout rate. Okay. Now, that gave them 18.2 billion free cash flow before acquisitions. They spent 116 million on premiums for goodwill, giving them 18.1 billion of free cash flow after goodwill. So back to, they generate 18 billion of cash flow. Where did it go? Right now, when we did Costco, there's one ratio that I overlooked. I want to come back to it. And that's the ratio of CapEx to depreciation. Okay. And I want to ask you from your accounting, why do companies have depreciation? Where does depreciation come from? What's the point of depreciation? Yeah. Yeah, and the reason you're allocating over the years you use it is because it's losing its value over time. And the depreciation is an approximation of a potential loss of value over time. Okay? So we often do straight line. Your asset's going to last 10 years. 1/10 is lost of value each year. That's the depreciation. Remember that from your accounting? All right, rule of thumb. If you're losing 10% of your value every year, you got to put 10% back into that asset to maintain it. That's a rule of thumb. So you pretty much rule of thumb, you got to spend your depreciation to maintain what you got. If I want to tread water, I got to reinvest depreciation. Otherwise, things are going to crumble. I'm not going to be able to sell as much. Now, there are exceptions to this. We were with a company recently where they had so much overcapacity that they're underspending depreciation because they just don't need it. Okay. But generally, companies don't buy stuff just to have it around. So if you depreciate something, you're probably going to put something back in. Rule of thumb. So if a company is spending more than depreciation, that's a signal that they want to expand. Right? Because if I'm building more plant that's wearing out, I'm doing that with the idea of growth in mind. So over 5 years, Nike's ratio was 200% CapEx to depreciation. That suggests that Nike expected to grow over the last 5 years. They spent twice as much in capital expenditures as was being depreciated. But in the short term, it's a very important signal. In 2023, Nike's ratio of CapEx depreciation was 141. Now, that's not as much signaled growth as the last 5 years, but they're still signaling growth for the next year, right? Now, that doesn't guarantee growth, but Nike was at least saying on paper that they probably expected to grow. And there's the short-term signal for growth for any company, CapEx depreciation. Getting tracking, makes sense? Next, how did 18.1 billion of free cash flow turn into 11.9 billion of CFI? So like Costco, Nike put in about 6 billion into non-operating cash. Where'd it go? Well, they generated 300 million of non-operating gains. That's helping CFI. They generated 481 million of after-tax interest income. So that's about, round off, call that 800 million of non-operating gains from income. They banked $5 billion in excess cash, 5.1 billion. They spent 1.9 billion in non-operating assets. So 8 billion went into cash and non-operating assets. That was the primary reason why the CFI is lower than the free cash flow. So 18 billion of free cash flow turned into 11.89 billion of CFI to pay out. Where did it go? Nike paid $1 billion in interest. So of the 11.8 billion, $1 billion went to pay the bondholders, $1 billion of interest. Nike borrowed $8 billion worth of debt. Again, do you think Nike really needed to borrow that debt? Probably not. So where this might be going. Nike paid $8.3 billion worth of dividends. Nike bought back $17 billion worth of shares. 8.3 and 17.5. That's about, call that rounding off 25.5, 26. But Nike also issued $4.6 billion of new stock. So 25.5 minus 4.5 is closer to 21. So net, Nike gave shareholders $21 billion. How do you give shareholders $21 billion if you only got 12? There's the debt. Now, this is a little bit more extreme than Costco, but a lot of companies did this because if you look at when they borrowed the debt, it was here. Most of the debt occurred for Nike in this year, which was 2020 going into COVID. But the point is, this was discretionary debt on Nike's part. But what do we notice over time? We notice over time with Nike, and this is now beyond your analysis. You got a question? In that year. Exactly. Why did they have a negative CFI in that year? Because their profits collapsed. And in that year when the profits collapsed, they still paid a dividend and they still bought back stock. So when my profits collapsed, how do I afford to keep going on all that repurchase to shares? They borrowed the debt. Now, remember in COVID, every stock price was falling and they probably said, oh, I could borrow the money at like 2%, 3% and use it to prop up my falling stock price, which is probably what's going on. A lot of companies are doing that. But I'm saying you can see that it's happening here. Now, that's not a good reason to buy back your stock. A better reason is, oh, I'm making more money and I got so much cash around here, I'm going to start giving it to the shareholders. Right? So you're like Johnny Depp in that movie when he's in like the cocaine business. There's marijuana and cocaine. And there's a part of the movie where they're in some apartment, I think in Miami, and they're just walking around with boxes of cash. They got so much cash going around. Like, what the hell are we going to do with all this cash? Like, that's not the situation Nike was in. Right? Nike, sorry for the metaphor, but Nike didn't have like so much cash lying around like, oh, let's go give it to the shareholders. Nike's like, no, oh, our profits are falling, our sales are falling, we're not selling our product. Let's go borrow from the banks and give it to the shareholders. Right? So what I'm just telling you is, yes, it rewarded the shareholders. But that is not as rewarding as if Nike sold a bunch more shoes. It's FYI. But regardless, that's for next week. 5 years connection events. Questions? All right, so this is called the CFI analysis. This is what you're going to do. ROIC CFI. Your company for homework 6, due Monday 10 a.m. is Target. I just put it up. So you have a CFI and an ROIC tree of Target, better known as Target, a discount retailer. Do this analysis, 500-word paper, use numbers, individual assignment, Monday 10 a.m. TAs have office hours next 2 days. If you're hopelessly confused, this has been recorded as a video. Take advantage of TA's office hours. Okay? Yes. Homework 7 got moved to the following Monday. Where's the sign-in sheet? Make sure you sign the sign-in sheet before you leave. Have a good rest of your week.